Hello and welcome, everybody. Happy Friday. Wow, I spooked the cat. Sorry. Welcome, everyone, to another Sectors Made Simple webinar. It's the end of a week, and thankfully, the market ended up for today, which is a welcome change after the past couple of ups and downs we've had. Moving into quarter three, we've seen quite a few changes, and if you want to stay up to date with our analysis of the market and how the market is evolving through this bear period, feel free to make a free account with Sectors Made Simple, and we send out a weekly newsletter to your email every single Monday, and it's free. So, if you like the insights that we provide here and you want some more of them, we send out those weekly newsletters every Monday for you to enjoy. But we're here today to talk about a slightly different topic. We cover on this channel quite a bit the idea of point and figure and why point and figure charting is so valuable to us. But there are other types of charts, and point and figure is not perfect. There are some things that point and figure can't do. So for that, and to cover the things that it can't do, we need other types of charts. One of our favorites, and one that was requested by one of our lovely subscribers, is Candlestick. Our subscriber wanted to know a little bit more about Candlestick charts, why we would use Candlestick charts for certain things, and how you read those charts. So today we're going to cover the basics of Candlestick, the advantages that it has over point and figure, and take a look at some Candlestick charts to put all of that information into practice. So let's get straight into the action, shall we? So today is going to be all about the basics of Candlestick charting. Now, really quick little disclaimer. Everything we're talking about today and mainly the metrics that we'll show, the indicators that we'll show, are meant to be an educational resource. This is not me explaining a strategy. This is not me explaining a way to use these indicators. Instead, it's a way of just sharing with you all some new information that hopefully you will find useful. So please keep in mind, this is all educational resources. These are not trading strategies. And whenever we talk about strategies, past results can never guarantee future performance. So let's talk about the goals for the webinar today. We've covered on this channel quite a bit about one specific type of chart. Point and figure. Getting ahead of myself here. But point and figure is not perfect. There's many things that it offers us to do, such as see price changes regardless of time. We cut out the time and instead focus on trend. And that's really useful, but we don't always want that. There are many reasons that knowing data over time, prices over time, are incredibly valuable to us. So today, I want to highlight one of the most common types of time series charts that we'll see: candlesticks. We're going to talk about what candlestick charts are, how to read them, and the differences between point and figure and candlestick, as well as how candlestick, again, we're not talking about the strategies, we're instead just talking about how we can use candlestick charts to make more complex trading strategies that wouldn't be possible in point and figure. Quick review on point and figure, in case you're coming to this and you might already know a bit about candlestick but know nothing about point and figure. I want to quickly talk about the basics of point and figure before we can talk about how candlesticks are different. Also, let me move this up a tiny bit. There we go. Point and figure, much like many stock charts, shows price changes over time. But instead of other types of charts, where every single column is one point in time, or one period in time, instead, point and figure follows trends, where every column is an uptrend or downtrend in the market. And we add new points to that column when the price goes above or below a certain price. The reason that this is valuable to us is that in a single chart, we can look at only periods of movement and ignore periods where nothing happened. For example, let's go quickly and take a look at a point and figure chart for SPY, the S&P 500 ETF. Everything from this point, right here, where you see that 1, everything from here and to the right is what we've seen so far in the past 7 months. So that is the size of 2022. 2021 is only between here and here. Same amount of time. In fact, 2021 is twice the amount of data that we have right now. We're about halfway through the year, but that half a year is almost twice as big as all of 2021 in total. So this chart is very, very valuable because it ignores periods of nothing. And when a lot's happening, it lets us focus on those periods. 2021 was a pretty calm year in the market. 2022, not so much. And we see that visually, where 2021 is half the size, less than half the size of just the first 6.5 months of 2022. So let's quickly talk about how we read this demonic game of tic-tac-toe. X's are uptrends. It is a positive trend in our cycle. So when we see a column of X's, it always starts at the bottom of the column and goes upward. Just like a column of O's is a downward trend, where we start up at the top of the column and work our way down as the price goes down. In order for us to add another link onto that chain, another piece of that column, what we need to do is have the price move into a new box. And we do that by, well, first let's talk about how we would do it for an X. It's when the price goes above the box price. So if we were looking at this as a chart, what you see above the line is the box price for that box. So in this case, this very top X would be the box for all prices between $178 and $179.99. This X, this very top X, would be drawn when the price would go above that $178 mark. For all those that are asking, this is Cleo. She is the Sectors Made Simple mascot. And she has a nice little seat next to me here, so she can participate in all the webinars. Now, that is when we're in a column of X's and we want to add another X on top. O's are slightly different because we don't need the price to go into that box. Instead, we need the price to go below that box. Same example again. If we wanted to draw an O in the box for $170, we would need the price to go below $170. So when the price goes below 170, we would draw that fourth O in the column. So now we know how we add new links onto the current column that we're going through. But how do we change direction? How do we go from X's to O's or O's to X's? In order to do that, we need what's called a reversal of 3 boxes or more. Cleo is going on a little vacation here pretty soon. So what that means is in order for us to have a reversal, we need 3 or more boxes in the opposite direction. Again, to see this clearly, let's go and look at our SPY chart. Let's zoom in right here. If you notice, this column where it says 7 is 3 boxes only. The current column that happened today is only 3 boxes. So we always need at least 3 boxes to have a reversal. Let me see if I can find a period of O's with 3 boxes. There we go. Right here, we have 3 O's going down. It does not include the top box. So from the top box, we need 1, 2, 3 in order to go into that new box. Just like for here, in order for us to go into a column of x's, ignoring the bottom box, we need 1, 2, and 3. So what does it do well? Why would we take some extra time to learn this, again, like I said, demonic game of tic-tac-toe? Because if all we care about is trends, if we are investing more mid to long term and we're focused more on trends and not daily price changes, these charts are very useful to us. Instead of focusing on time as the most important thing, it focuses on the direction of movement. When things are going up or down, that's what it cares about. It ignores periods where there is little to no price change, and instead shows us periods where there's lots of price change, like we saw with 2021 being less than half the size of the just first 6 months of 2022. The other thing is that it allows us to see reversal points very, very clearly. Looking again, every time we go from X's to O's or O's to X's, we see a change in short-term direction. Every time we see a column of X's go above a previous column or a column of O's go below the previous column, we have what's called a breakout or breakdown. These are larger changes in long-term or longer-term strength. So using X's and O's, we can get the short-term direction of the stock's price. Using breakouts or breakdowns, we can find the longer-term strength or the longer-term trend of that security. That's what point and figure does well. We're not going to talk just yet about why Candlestick is better. Before we do that, let's just instead talk about Candlestick. Let's go into the basics of Candlestick and say the advantages that it has over point and figure. There is no perfect type of chart. It is not that point and figure does things wrong, it's that Candlestick does some things better. Candlestick is what's known as a time series chart. What that means is it's some big spooky words to just say it follows things over time. Just like we follow time in seconds, minutes, and hours. Candlestick follows time through bars. Each candlestick bar gives us 5 pieces of information all in one. And each bar is one period. This word period is a little self-explanatory when you think about it as a day, where every bar is one day. But it doesn't have to be. A candlestick chart can use bars that are 1 week. If you're looking really long term, each bar can be a month. Or we can go shorter. We can go every bar is 1 hour. Every bar is 30 minutes, 15 minutes. If you're really crazy, you can do 1 second. Again, the advantage here is that point and figure, we don't get to choose a period. The period is just price changes over time. Directions. Doesn't matter how long it was in a trend, it just matters that it was in the same trend. The minute it changes trend, okay, cool. If it changes trend in 3 weeks, all right, 3 bars. Candlestick's not like that. Time series charts are not like that. They follow time, where it doesn't matter how much or how little happened in that time, time passed and we're here to record it. Now that we've covered that, let's go and look at candlestick charts and see these 5 pieces of information that it provides us. This is a candlestick. The candlestick has a couple of different parts, much like a normal candle would. But we're not talking the new fancy candles that you can buy. We're talking the super old ones. The ones where you would have to hold a string yourself and then fill it up with wax that would dry and create a candle. On the bottom of the candle is a little string. It's whatever was left over at the bottom. Then you have the body of the candle. It's bigger, thicker, it's got a bottom and a top. And then you've got the string that comes out of the top. And that is our candlestick. Like I said before, it gives us 5 pieces of information. 4 are in the candlestick itself, and then 1 is in the format, or how we make the candlestick. The first thing that we have is the open. This is the price at the beginning of the period. What did it start off that period at? If we're talking about a green candlestick, and I'll talk about the difference later, but for right now, bear with me. We're going to say that the open is the bottom part of the candle body. The bottom of the stick is the low. So when a stock opens, let's go and just take a look quickly at SPY's price for one day. We have the open. It's what it started the day at. They ring the bell, trading starts. What was the first price of the day? The low is, it bounces up and down throughout the day. What's the lowest it got to? In this case, for SPY today, the low was 380.55. The open was 382.62. If you're following along at home, you might have a good inkling about what number 3 is going to be. Well, apparently that's 4. There. 3 is going to be the high. This is the highest price that it got to in the day. So going back to our SPY example, the high for the day was 385.25. And then the fourth, the top part of the candle's body, is the close. That is the price that it ended the day at. Now, if the candle is green, or if it's hollow, that means that the price went up during that period. So when we see a green candle like this, it means that the price went up that day. It might be green, it might be black, and it depends on what charting you're looking at. Some will do it differently. For example, stock charts reverses it. Stock charts, they'll have green, but also hollow reds. So different places will have their charts done differently. But typically, hollow candle means that the price went up that day, and green means that the price went up that day. The only reason why this one isn't hollow is just so it's easier to see the color, by the way. Let's now talk about the other side of things. When the market goes down in a day, the open is now the top part of the candle. The low is still the same. The high is still the same. And now the close is the bottom part of that candle. So if the candle is red, or usually it's filled in, that means that the price went down in that period, not up. Let's quickly go and take a look at one of these charts so we can see this for ourselves. I'm going to set the green color to, or the up color to green so it's easier for us to see. And welcome to Christmas, everyone. What we see now is a chart where every one of the green lines is a single day that the price went up. When the price goes up, let's actually zoom in here for a second. we get those 4 pieces of information. The green bottom is going to be the low price. Or sorry, the open price. The top for a green is going to be the close price. And the stick up or down is the high and the low. If you notice on this bar that I'm looking at right here, just to the right of this vertical line below the 55, there is no bottom of the stick. The reason is that the open was also the low for that day. It is possible that the low is either close to or is the open of that day. Just like if we go 2 bars over, the high of these 3 days is also the close of those 3 days. Then, on the other side of things, let's look right on this vertical line. This almost cross. There is very little body to this chart because the open and the close prices of that day were almost the same thing. March 21. Let me see if I can actually pull up the chart for that stock on the 21st of March. Let's go to chart, 1 day. I'm just on the other screen trying to get the chart all set up for us. So what did I say? 321? 321. So what's interesting is this chart has it slightly different. This one has it in red instead of... Okay, come on. Play nicely. It's not playing nicely. Sadly, you're going to have to take my word for it that in that day, we saw the price go up and down throughout the day, but the open and close were nearly the same thing. Looking further over to the right, we see plenty more examples of this kind of chart, or this kind of action. Right here is another example, where we see a big stick up and down, showing that there was a decent amount of price change in that day. But in the middle of the chart, almost no movement. We did end up for that day, but the amount that we were up was very little. The highest we got to was up here, the lowest we got to was down here. The open is the bottom part of that candle, the top part is the close. Let's go and find an example that we can do for a down day. Let's use this big, thick candle right here. To the left of the line underneath this 0. Tiny little stick above and below. So the high and the low were very close to the open and the close. The open was up at the top of the candle. When it's red, the top is that open. The bottom is going to be that close price. So this day, the price went down pretty significantly. The high was pretty close to the open. The low was pretty close to the close. And again, this is all looking at one day. We can change this if we want to make it weekly. So now every one of these bars is 1 week instead of 1 day. Other websites, such as TradingView, if you use TradingView, can allow you to change these charts even more. Where within TradingView, we get the ability to... Oh, it's going to make me log in, aren't you? No, it's not going to make me log in. On TradingView, we again have all of our candlesticks here. And we can change daily to be whatever time we want. Let's do 5 minutes. Now what we're looking at here is all the 14th of some month, this month. The 14th of July. So the 14th of July, all the way to the right. Then here's the 15th. So now every one of these candles is 5 minutes in the market. And we still get all of those same parts. So we get the low and the open, the high and the close of the 5 minutes instead of the day. So at this, the clock would strike 1:30 in the afternoon, start this bar. The bottom price is the open for that period. The top is the close of the candle is the close. In this case, the low is the same as the open, and the high is way up here. Like I said before, we can't do second. What can we do? Okay, the closest or the shortest we can do for free is 1 minute. So now every one of these bars is a single minute in the market. Same thing as before. If you don't see a top or bottom of the candle, it doesn't mean that it's not there. All it means is that the high or the low is the same as the open or the close. If we look at this one right here, it is a perfect rectangle because the bottom, the open, is also the low, the high is also the close. If we look at this rectangle at 7:24, I'm assuming that this is UTC. Yeah, it is UTC. Let's change this to be LA time. At 12:24 Pacific time now, there is no string. There's no string coming out of either end of the candle because the high was also the open, the low was also the close. And this goes on and on and on and on. This right here is the opposite example, where we see a lot of string, little candle body, because the open and the low, the open and the close are very similar. But there was still price change in that period. That price change is just pretty small. I don't even think that's big enough for it to pick it up. Yeah, you can barely see it on the stream. It is, they make it pretty tiny, sadly. That is the basics of how to read Candlestick. We have colored or hollow versus filled body. The string is the high and the low for the day. The candle body is the open and the close. If it's a green column, that means that it closed higher than it opened. So the bottom is the open, the top of the candle body is the close. If it's red or it went down in that period, the top is the open, the bottom is the close. And the period is whatever we want it to be. 1 minute, 5 minutes, 1 hour, 4 hours, 1 day, 1 week, 1 month. Take your pick. That is the basics of Candlestick. So now let's talk about why we use Candlestick. Like I mentioned before, and like I was just showing, Candlestick doesn't just give us one price per day. It gives us those 5 pieces of information: open, high, low, close, and if it profited or not. We can visually see changes in price over time. You don't need to follow a line up and down. Each period is just a single stick. You can see how much change there was by how long the string is. You can see how much the end change was from the open to the close by how big the body is. And we can also clearly see periods or days of profit and loss. It's very easy to see. Lots of green bars. We were probably making some money if we were buying long. Lots of red bars. Maybe not making as much money. Unless we were shorting things. This ability to visually see a chart and not have to read it to get information out of it is valuable. It lets us quickly look and know what's going on. We can see volatility, we can see price changes, we can see trends and everything. All just in a quick glance. And here's the difference, and here's why this topic is so valuable for us to talk about. There's one thing that point and figure cannot do, and it's called indicators and oscillators. Now, indicators is a little bit of a misleading term in this regard because an oscillator is technically an indicator as well. So the better thing to say is that it's overlays and oscillators. And these all fall into the same group known as technical indicators. Technical indicators are big freaky words to just say it's pieces of information that we can calculate, usually math, to take price, volume, or other time series values that we have and do technical analysis with them. Romulo, Jonathan, do you think volume is the important complement to read the price change? Depends on how you're using. It depends on how you're using the charts. One of the original strategies that I learned about when my mom was teaching me the basics years ago was you use some fundamental analysis thing, be a profit, will you, to find a group of companies. And one of the main criteria for when you buy is when the volume is double its average volume. So you can use a moving average to find the average volume and look for a day that the volume is over double. Many strategies do use volume because more people buying or more volume of trades means people are either getting in, which is a good signal as a buyer, or people are getting the heck out, which is a good signal as a seller. Do all strategies use volume? No. One strategy that my mom's talked about with Sectors Made Simple subscribers, which is using RSI and STC, that strategy doesn't use volume at all. So it really depends on that strategy. Many strategies will also use, like I said before, an average of volume over time. Volume is a value over time that we can create an indicator for. You can find the average volume and then see when the volume is over double its average rate. But I think I'm getting ahead of myself because I said a word there, moving average, that's going to come a little bit later on the slide. So let's step through this and talk about exactly what a technical indicator is. These indicators are any sort of math that we can use our prices, volume, open interest, whatever it might be for this security. As long as it's time series, as long as it's one piece of information per period, we can use it. At least one piece of information per period. Most of the time that we'll see technical indicators, we're going to look at prices. I did just give an example, though, of how we can use it for volume. But the vast majority of the time that we're going to see them and we're going to use them, it's going to be using the price to make these indicators. Please note, today's presentation is called Candlestick Chart Basics. What I'm about to talk about, these technical indicators, do not rely on only Candlestick. You can do these with line charts. You can do them with anything. As long as it is a way of looking at prices over time, where each bar is a different period of time, we can use Candlestick. Now, these technical indicators come in two main types: indicators and oscillators, or overlays and oscillators. We're not going to go into too much detail about how to calculate all of these different overlays and oscillators. Instead, we're only going to talk about the differences and some examples of common ones that you might see or hear about. Let's start off with our indicator overlays. These overlays are, like the name says, stuck on top of the chart itself. They can be put on top of the chart itself. They use the same scale. So if it's price, they still use price as their metric. If it's volume, they still use volume. If you're looking at options and they use open interest, it's still looking at open interest. Now, as the name suggests here, we can overlay these indicators on top of the main stock chart so that we can compare this overlay against the security. Some of the most common overlays that you might see are going to be both simple and exponential moving averages so that we can see the average price over a period of time. Again, I'm going to probably say the word price. It's the most common thing we use for overlays. So if I say price, remember it can be volume, open interest, anything like that. But we can use these prices to make moving averages, parabolic SAR, which is tracking trends, uptrends and downtrends, and pivot points, which looks at support and resistance barriers. Let's go and take a look. Let's go and we'll head back over to stock charts and we'll look at some of these overlays in practice. Let me make this back to daily. Is there anything else I want to change here? Let's shrink it. Oh, that did not do what I wanted it to do. Let's go back to 700. Okay, that'll do. Right now, what we have is price and volume. I'm actually going to get rid of the volume. Oh, come on. Volume off. There we go. So now it's very clear what we're looking at. Price. On the right side, we see the price that SPY has been over the past 6 months. Every one of these lines or candles is 1 day in this chart. The range of the chart goes from $470 down to $370. Let's go ahead and add a moving average. We'll add a simple moving average of 22 days. 21 to 22 days is the average number of trading days in a month. So this is now going to look at every 22-day period and say, what was the average over those periods? And then chart it so that we know from that day, 22 days back, what's the average. Now this line in blue is that moving average. What this lets us do is it lets us see periods where our price is below the month moving average or above the month moving average. We can also change this to 5 days. Now we can see much shorter term when we have a trend that is above its moving average or below its moving average. And many strategies rely on this. One strategy that I've seen in the past relies on looking at a stack of different moving averages. I think 5 or 6 different moving averages and saying, I want the price to be on top of them all. Show me companies that It's a 3 above the 10, above the 20, above the 50, above the 100, so on and so forth. So this is probably the easiest one to understand. Then we have parabolic SAR. This one is a little bit more complex to calculate, but is going to be our trends. So trends are going to be these uptrends and downtrends, showing periods where things were trending up and trending down. And some strategies will rely on buying when we see a trend reversal from down to up. Then we are going to have the final one that I'm going to talk about. Someone was actually asking about VWAP. VWAP is volume weighted average price. It is slightly different, where we need our volume to actually do this one. And it still won't let us calculate it. But what it does is it tries to say when there's periods of more price change, we need to weight the prices based on the volume of that day. So is price the same as volume weighted price? No, because volume weighted price is going to look at price for a specific set of volume. So for 1,000,000 shares, what was the price for those 1,000,000 shares? For the next 1,000,000 shares, what was the price for that 1,000,000 shares? So if we throw 100,000 in there, it's still undefined. All right. I don't think I'm going to be able to get that set up right away. The last one I want to show is pivot points. This is probably one of my favorite ones, because pivot points allows us to see support and resistance barriers. One of the biggest advantages of point and figure are these support and resistance barriers, and being able to see periods where we break above a resistance barrier or we fall below a support barrier. Now, all of these, as you've seen, take place on the same stock chart. They're all on the same price chart. Or if they were volume-based, they would all be on the volume chart as well. Let me get rid of this. This is why they are called overlays. We stick them on top of the stock's price chart. Let's now go and let's talk about the other side of these oscillators. Oscillators are going to be charts that don't fit onto the same stock chart because they use a different scale. Their scale might be a percent. It might be centered around 0. It does many different things. Anything that is not an overlay, anything that doesn't use the same price or the same volume, is going to be an oscillator that's going to fall on a chart below or above the main chart, depending on how you set up your screen. Some commonly used oscillators include relative strength index, or RSI, moving average convergence and divergence, MACD, which centers around 0, relative strength index is a 0 to 100%, and shaft trend cycle, STC, which is also going to be a 0 to 100%. Let's go and take a look at a couple of these oscillators, shall we? If I can grab my chart back, there we go. I'll get rid of the overlays. And now let's go and add an indicator. So now with these, we're looking at all of our oscillators that we can add. So the first one we're going to do is MACD. MACD looks at two different periods. So this one is going to be looking here at the 12 and 26 day moving averages to compare those two against each other. We'll see the 12-day moving average in black, the 26-day moving average in red. So we can see periods where the 12-day moving average is outpacing the 26-day moving average, and we can see periods where the 26-day is outpacing the 12-day. Additionally, this blue number shows us the difference between the two so that we can see points where they cross over, where one gains strength over the other. And if you notice, all of these are different values. They are centered around a 0 point, and it ranges in this case from 5 to 10, negative 10. Obviously, that's not a price. We can't have negative prices. So all this is looking at is a different value entirely. It is this moving average difference. The next one I want to show off is going to be RSI. RSI tries to look at the variance in price over a period of time and tries to show us points where we have a trend of upward momentum or a trend of downward momentum. The math behind it's a little complex. It basically looks at what was the average when the market went up, what's the average when the market went down, and then every day we add in new pieces of information. It works similar to an exponential moving average, but not what I'm getting into today. Instead, what I want to show is that this value is bound between 0 and 100%. Right now, it is 50%. We consider any RSI below 30% to be oversold, and we consider any RSI above 70% to be overbought. If you know anything about BPI, bullish percent indices, it works very, very similar to those. That is RSI. It is a percentage between 0 and 100%. Obviously, we can't stick that on a stock chart. It doesn't belong there. The last one that I want to show is going to be shaft trend cycle, which we don't have on stock charts. For that, we need to head over to TradingView. So let me get TradingView booted up, and I will throw the shaft trend cycle on for us. Come on, where is it? There it is. Now you're making me log in. I see how it is. Bear with me one moment. Okay. We have a similar kind of chart here. We've got our candlestick charts over time. Each one of these periods is 1 day. And down below, we have our shaft trend cycle. It works similarly to MACD, but it's instead of showing moving averages and how the difference between those moving averages are working, it tries to plot things instead on a 0 to 100% scale. Upward trends will be seen in green, and they will start off slow, ramp up, and then slow down again. And we'll see that here. In green is an uptrend, in red is a downtrend. And once again, these values are bound between 0 and 100. Obviously, that won't fit onto a stock chart where the prices are 420 down to 360. So they fit onto their own chart down below. So let's review. Technical indicators, we use price, volume, open interest, anything to find a new number. If that number is still a price or is still volume, we can stick it on the main chart in the form of an overlay. such as moving average. If we have an oscillator, something that doesn't fit onto the main chart, it's using a different scale, be it centered around 0 or, in this case, 0 to 100%. We will have them on their own section down below, and those ones are called oscillators. So indicators is the big group. Overlays, same scale as our price, open interest, volume. Oscillator, its own scale, obviously can't put that onto the chart, so they'll have their own chart down below. Let's wrap things up now. Point and figure is unique. It does many things that normal stock charts don't. It defines resistance and support barriers clearly. It focuses on periods of significant price change instead of just periods of nothing. But it does come at a trade-off where we lose that time series element. We lose the ability to know what's happening every single time the clock ticks. Time series data is still very valuable and allows us to do types of analysis that point and figure just doesn't allow for. With Candlestick or any time series chart, not only can we change what the period of time we're looking at is, be it 5 minutes to 1 day to 1 week to 1 month, we can also create more advanced trading strategies by using these technical indicators. If you are a Sectors Made Simple annual subscriber, or if you wish to become a Sectors Made Simple annual subscriber, my mom, who is in chat with us, Julie Stav, has a class series running right now, where she uses TradingView, that charting website that we just saw, and uses technical indicators and candlestick charts to create trading strategies for both short-term investment in the form of options trading and more long-term investment in the terms of both options but also more traditional stock assets as well. So if what I've been talking about today is interesting to you and you want to learn about how these oscillators and indicators can be used for real strategies and to see some real strategies, consider purchasing a subscription, joining those classes, and seeing how point and figure isn't the only way that Sectors Made Simple helps you to invest simpler. So, that is what I had to cover for you all today. I can take some questions if people have them. Jonathan, you mentioned if we see red candles, we may like them if we're longing. So, red candles is for shorting. Long investment means that you're buying something hoping it goes up. Short investment means you're buying something hoping it goes down. Puts is an offer to have, puts are an option for selling. So if you buy a put, you're hoping that that thing goes down in price. If you buy a call, you're hoping that that thing goes up in price. With a call, it is an offer to buy a share at a specific price. So if SPY's price right now is $385 and you bought an option to buy SPY at $385, you hope it goes up in price, because if it goes up to $400, you now have an option to buy 100 shares of SPY at $385 and instantly sell them for $400. If you buy a put, it is an offer to sell at a certain price. So if you had a put for SPY at $385, you hope that the price goes down, because then you can buy something in the market for $350 and instantly sell it, exercising your option for $385. You can also short stocks, but shorting stocks has their own world of complications and considerations and risks, so I'm just going to use the example right now of options. Are there any other questions that people have? If there are no other questions, then this is where I will leave you all for today. Thank you all so much for joining us. If you have been following Sectors Made Simple, or if you haven't, we've been running an education series called Figuring Out Finance. It covers the basics of financial investments, all from how to actually invest, but also the basics of interest rates, banks, brokerage accounts, and all the skills that you would need to know to get a head start on your financial journey. If those classes seem like something you or your kids or friends or brothers would be interested in, or dogs, I don't really judge, anyone that might find that information useful and could use getting their financial journey started off on the right foot, please feel free to take a look at the registration information. I will put the link for that registration in chat right now if you are so interested. Also, if you are a Sectors Made Simple subscriber, you are entitled to a 50% discount on your registration for these classes. So if you are an annual subscriber and you're interested in that, send us an email at support@sectorsmadesimple.com and we can get you sorted out with that coupon code. Last thing, today's webinar was thanks to a subscriber that emailed us wanting to know more about Candlestick. If there are topics or things in the world of investing and finance that you're interested in and want to hear us cover in one of these upcoming webinars, you can always email us and we'll do our best to help you invest simpler. So thank you all so much. Have a great weekend. Bye.